Welcome everyone to today's seminar in Search and Matching in Macro and Finance in our seminar series. So we're very pleased to have Quentin Vandeweyer today presenting the fiscal cost of quantitative easing. This is joint work with Adrien Davernat, Antoine Hubert de Fraisse, and Liming Ning. Some of them are also in the audience, which is great. Yeah, and so now we also have a great set of panelists today, so I'm hoping to have a great talk and also a great discussion. So now I'll give it over to Quentin, and yeah, please take it away.
Yeah, thanks to Cass for the introduction. Thanks for having me presenting my work in this group. I think it's like usually I don't connect too much to this space, so I'm very happy to eventually do that and get your feedback on this specific paper. So as Lucas mentioned, this is joint work with Antoine Hubert de Fraisse. I see he's here in the audience. Adrien Davernat is also here. I think Liming might join a little bit later as well. I also want to mention to Adrien and Antoine, if at some point you feel that my answers are not so satisfactory, feel free to jump in as well. And anyone feel free to jump in to ask questions. Okay, so the paper is called The Fiscal Cost of Quantitative Easing. And so let's start with some motivation. Actually, the motivation for this paper is quite straightforward. You really have to look at the large losses that central banks have been making since interest rates started going up, based on their QE programs that they were undertaking for quite a bit of time for now. So here, just to motivate that, I have a couple of numbers on the slide. For instance, you look at the US for 2023, the losses were over $100 billion of operating losses. And if you count the whole mark-to-market losses on the Treasury portfolio that the Fed has, it's close to $1 trillion. For euro area, it's around $73 billion, billion euros, sorry, of operating losses. The UK is also quite large, around $47 billion US in operating and close to $250 billion in mark-to-market. Japan's also very high. And so unsurprisingly, we've also seen a lot of press coverage of that with like potentially some political economy implications. One of which is that now many economists in particular, Paul de Grau and Cotter, have been like consistently now calling for the central banks to stop paying any interest on reserves, so they would stop incurring all these losses, which they think is like coming from just like some not necessary subsidy they are giving to banks. And then kind of like almost on the other end of the spectrum, you also have some other people that are basically claiming that these losses are completely inconsequential and they can in a way just like being carried forward and they don't have any implications at all. So the question we're going to ask in this paper is, what is the right measure for this economist cost of QE? And we're going to look at it from a fiscal standpoint. So in order to get there, I want to do a little bit of a detour by reminding everyone how do central bankers think about what they do when they do something like quantitative easing. So one of the channels they usually mention is something called duration extraction. And here I have a quote from Philip Lane, who is the chief economist at the ECB, who's explaining what he means by duration extraction. So he's saying, in purchasing long-dated assets, the central bank takes duration risk off private hands, which translates into lower term premia and longer interest rate and long-term interest rates. And so you're familiar with this finance paper that's been around for quite a bit of time from Villa and Vallanos, eventually published in 2021 in Econometrica. This is exactly the kind of mechanism that the duration extraction channel is capturing in partial equilibrium, where what you do when you do QE is that you're buying some of the long duration assets and you're reducing the duration risk that these arbitrageurs have to bear in equilibrium, and therefore you reduce the term premium or the risk premium on long-term assets. But here the idea is that this model is really a partial equilibrium model, whereas we know that duration risk, interest rate risk, is actually a systematic risk factor. So if you take that perspective, it has to be absorbed by some agent in general equilibrium, which is usually not the case in most of these partial equilibrium models. And in practice, who is going to bear that risk? Well, it's going to be first the central bank, but then the central bank is owned by the government, and eventually the losses will have to be absorbed by future taxes, and potentially these taxes can be distortionary. So this is where the notion of like the real economic cost is going to come from in our paper. Okay, so what do we do in this paper? Basically, we take a consolidated government balance sheet perspective, and if you do so, then QE becomes just a swap of assets, of government liabilities with different maturities. When the central bank buys these long-term assets, it just removes them from the market, and then in exchange, it's putting some interest-bearing reserves that are basically floating interest. So there's a swap of maturity. You're going to reduce the aggregate maturity for the overall government whenever the central bank does QE. And so typically the reason for doing that would be that if you are the zero lower bound, you might not be able to move the short-term interest rate around. And so for that reason, you might want to use these long-term interest rates in order to get some more macroeconomic accommodation. So effectively, there is a trade-off here, where on the one hand, because you reduce the aggregate maturity of the government debt, the government is now going to incur some more rollover risk. And I'm going to define that more precisely later. But it might be actually worth doing that on the margin, because when you get a zero lower bond, now you're going to get more output. And so the first part of this presentation, the paper, we're basically going to present a stylized model in which this trade-off is actually operative. And it's going to be somewhat for illustration purposes. So the way it works is that we are going to assume that there are convex distortionary taxes, like in Barrow 1979. And so this basically means that whenever the central bank is doing QE, this is going to increase the tax volatility because it shortens the maturity of the aggregate debt. And in expectation, this is going to result in an increase in deadweight losses. Why? Just because of the convexity. There's effectively like a Jensen's inequality term that operates. The positive news, the positive shocks when interest rates get lower are not fully compensated by the negative news when interest rate gets higher because of the convexity, effectively. And so that's effectively the measure that we are going to try to assess in this paper. That's what we are really after here. And then on the other side, we are going to have the zero lower bonds. There's kind of like a new Keynesian light part of the model, which is going to be a combination of zero lower bonds, some fully sticky prices, and the presence of hand-to-mouth households. And all of that together is basically going to generate the following: that at the same time, QE is going to reduce the bondholders' precautionary savings motives, and therefore this is going to prop up aggregate demands. Fundamentally, what's going on in here is that the central bank is effectively redistributing risks from the bondholders to the hand-to-mouth households, which are bearing a part of the taxes. And so that's the trade-off that's what we're going to use to model the trade-off I just mentioned. And then in the second part of the paper, we are going to try to quantify this trade-off and specifically calculate for the US, for the different various QE programs, we're going to calculate the expected deadweight losses from taxation that are induced specifically by all these QE programs. And then after that, we're going to compare those to the output effect, the benefits of doing QE that has been estimated in the literature, and we're going to rely on a meta study by Fabo and et al. So that's basically the plan for the paper. Okay, so I can already preview the results so that we know where we're going. So we're going to start with a bunch of theoretical results. The first one is that, as you might already expect, because we have a trade-off, there's going to be an optimized size of a QE program, which is going to be an interior solution here. Effectively, you're going to make sure that the marginal cost of doing this QE program, which is going to be marginal increase in rollover risk, increase in these deadweight losses, will have to be equal at optimum to the marginal output benefit gain that you get. And it's kind of like the main result of the paper, main theoretical result, which also means that now we can derive what is the optimal size of a QE program. We're going to see that very intuitively it depends on the dispersion of interest rate risk. So how much interest rate risk you have at the time where you start the QE program. And the more interest rate risk you have, the less of QE you want to be doing, because the more that's going to translate into tax volatility. The second one is going to depend on the level of tax distortion. If your economy has a lot of tax distortion, then you'd want to be doing less of QE. And then it's also going to depend on the depth of the zero lower bound, because here in this simple model, you don't want to be doing QE outside of the zero lower bound because there is this cost of doing QE, which you don't have when you do conventional monetary policy. Depending on the time I have, I'm going to mention two additional results. The first is that QE actually becomes neutral whenever you finance QE issuing reserves that do not pay interest. So like in the proposition of Paul de Gros, if you were to just issue a bunch of non-interest bearing reserves to finance your QE program, in that case, you wouldn't have the rollover risk, but you would also not get the benefits of QE. Why is that? Because effectively, non-interest-bearing reserves are long-duration assets. They're like fixed income assets. And so if you just swap one long-duration asset for another long-duration asset, then there is no effect in the marginal risk that these bondholders are taking, and so QE becomes moot. Another one as well that some people might argue that part of the reason why QE losses can be inconsequential is because the central bank is effectively like a bank in the sense that the seigniorage revenues basically are going up whenever interest rate goes up. So the central bank has like this natural hedge against interest rate risk, and so for that reason, it might be perfectly fine if the central bank takes actually duration risk. We're going to see that in our model, this is not the case. Why is that? Because the Treasury should already take that into account in the first place. The Treasury already knows that there is this pro-cyclical seigniorage revenues, and it's going to take that into account for what is the optimal maturity of the government debt without getting in the zero-low bond. So on the margin, when you get a zero-low bond, this does not affect the trade-off for doing QE at all. And so for that reason, central bank should not take that into account either. Okay, so then we're going to get to the quantitative results. We are going to find actually that under some conservative assumptions, and I'm going to explain those in details later, every US QE program actually had some positive net present value. So we actually find that the cost benefit, even though there is a cost, it seems that the benefit seems to have overcome the cost in this specific case. And this is due to a series of different factors. The first one is that actually the literature has estimated a quite large output effect for QE. We are going to average across different papers. And if you do so, you get something around 3.4% of GDP cumulatively for all the QE programs. So that's the first reason why. The second reason is that the way we are going to get at the interest rate risk ex ante that the central bank is taking is by using some off-the-shelf term structure models. And then this off-the-shelf term structure model, they effectively forecast relatively limited interest rate risk dispersion. And so that's the second reason. Another one is that term premium has been quite positive on average, which basically means that central bank have run a positive carry for quite a bit of time, which helps offsetting the negative current effect we see. And then the fourth one is that that's something I should really caveat here, is that everything we're going to do is going to be under some monetary dominance assumption. So basically the idea is that down the line, the fiscal authority is going to increase taxes to compensate for the losses of the central bank so that there's no additional inflation. And we're going to basically maintain that assumption during all of this talk. Otherwise, if you were to remove that assumption, there might be like other things happening, like for instance, a political economy cost of like shifting regime between monetary dominance and fiscal dominance, for instance. Okay, let me move on then and tell you about the model first and theoretical results. So just to get there, I just want to make sure we're all on board with the constituted government perspective that I just mentioned. So what is QE in this sense? Effectively, QE is the central bank is going to buy a bunch of long-term debts from the treasury and issuing some short-term debt, which are also liability from the considered government. So effectively, what it does is just going to replace some of the long-term debt here by some of the short-term debt. That's effectively what QE is doing on aggregate. Okay, so let me tell you about the environments. So we have 3 discrete time periods, 0, 1, 1, and 2. And then we have S states that determine the productivity. So there's going to be a productivity shocks, and each state has a probability pi of S. And all the uncertainty is going to get realized in period 1. We have 2 agents types, and these have CRA preference and risk aversion gamma. And then we're going to assume that we have a mass theta of domestic bondholders and a mass 1 minus theta of hand-to-mouth households. And for simplicity, I'm going to assume that only the households are paying all of the taxes. I can relax that. But what's important is that the amount of taxes has to be disproportionately on the hand-to-mouth household relative to the bondholders. Then we have that the foreigners are going to hold a fraction psi of the bonds. We are also going to assume that prices are fully sticky. And this is just basically going to fix the price level. This is a trick we get from this Caballero and Simsek paper. The underlying idea is that all of the slack in demand is going to be reflected in a slack in output, so that price is basically unaffected, inflation is unaffected. That's just going to make our derivation simpler. And again, I want to say here that the purpose of the model is really to be illustrative. It's kind of like a proof of concept that we can get a model where we can get this deadweight loss cost, which is what we want to estimate, at the same time as having these output benefits. But arguably, you would think that there are like many other channels that this model is not going to be able to capture. And so we have the zero lower bound, as I mentioned. Zero lower bound is like the short-term interest rate cannot go below 0 in period 0. So the zero lower bound is going to apply only in period 0. And then there's this utilization rate, which is going to help us tracking down how the effective demand is doing relative to potential. And then we have some quadratic distortionary taxes, which here are just going to be captured by this reduced form estimates, where it's parameterized by this parameter alpha. And it's something we're taking from the Greenwood and Sonnenstein paper. Also, I should mention that there's no search and matching thing here, but I guess it could have been worse because I don't have money in the utility function. So, but thanks for inviting me for presenting this paper nonetheless. Okay, so here is the main problem. That's the problem for the bondholders. So bondholders, they want to maximize their lifetime utility of consumption. And here is going to be very standard. Basically, they need to choose how much consumption they get for the 3 periods. And they also need to choose how much of the different kind of debts they are holding. So how much of the short-term debt. So the short-term debt basically gets you from period 0 here to period 1. And then there's a long-term bonds, which basically gets you from period 0 to period 2. And then once you get at period 1, you need to decide how much of these short-term debts you're going to roll over. And it's going to be the most important variable here. This is the B1S thing. And so this problem is very standard. So the solution is also very standard. This basically just gives us that the first order condition for the price of these bonds should be equal to the stochastic discount factors for these agents, for these bondholders. So the households are even simpler because they are hand to mouth. They are just going to consume whatever is their post-tax endowment. And here the idea is that they are going to bear all of the distortionary effect of taxes as well. Then we have the central bank. Central bank is also very simple here because the central bank is just going to do conventional monetary policy in a sense of setting the short-term rates. And it's going to do so just to maximize output because of this fully sticky price environment. There's no inflation. So there's like a single target environment. You just want to make sure that try to maximize output. So I can already give you the preview of the solution here is that as long as you know that there's your lower bound, what you want to be doing is setting the interest rates equal to the natural rate so that output is always at potential. Okay, so here is the interesting problem. So this is the government. So the government has to choose a tax schedule and also a bond issuance schedule. And for the different kinds of bonds. And just for simplicity here, we're going to assume that there's only one public expenditure, which is a legacy public expenditure that happens at G0 that you need to finance, and after that gets to 0. So how does it look like? Effectively, the government is going to maximize the discounted output for the domestic agents, for all the domestic agent nets of tax distortions. We are just going to be the discounted output for all different periods, output, and then net of the distortionary taxes here, which is like this second term. In 1 second, I'm going to tell you about how I get this discount factor. We have a simplification assumption there. And the government is going to do that in sequence, conditional or as a budget constraint, conditional budget constraints. So at period 1, it will have to choose how much of this TO1S, which is the tax schedule in period 1, and also how much of these short-term debts it's actually rolling over.
Quentin?
Okay. Yeah, sure, Jonathan.
Can I ask you something about this objective function? It seems quite special, isn't it?
Yeah.
Would it be very different if you write down the welfare function of?
Yeah, so that's what. So there would be like 2 differences, which is what my next slide is about. So effectively what we're trying to do here, and it's kind of like the purpose of this whole exercise, is really trying to write a simple and clean model that's going to isolate the trade-off we are after, which is the trade-off between rollover risk and the output benefits of getting at the zero lower bound. And for that reason, we are going to shut down a bunch of different additional channels. So there are two channels that are shutting down by writing it in such a specific way. The first one is that we're actually going to use in this function here, we're going to use the discount factor of the bondholders rather than the discount factor of all of the agents in the economy. So this is why we don't write it in the traditional welfare way. And the reason why we're doing this is basically because we want to abstract from some market completion motifs that would be there otherwise. The reason is that because some agents here, markets are incomplete because agents are hand to mouth. And because they are hand to mouth, effectively what the government would like to do is to complete the market and making sure, like basically improving the risk sharing because between the bondholders and the hand to mouth households that are paying taxes. And so by using here the discount factors of the bondholders, we are basically shutting down that channel. Not that we think that it's not an interesting channel, but we just don't want to. The interaction here is going to be very complex with what we're going to talk about. So for that reason, we just refer to this very interesting paper by Dejanier Silva, who is looking at this specific problem, and we basically orthogonize the two problems, and we look at the other part of the problem. So that's the first part, but there's also a second part, which is that the government is going to act as a price taker, meaning that it's not going to internalize its price impact, which is going to come from the fact that his tax schedule and debt schedule is going to affect the Euler equations of the agents, and therefore is going to affect how much interest rates he has to bear, and therefore how much distortionary taxes he's going to have. So once you allow for that, the problem becomes much more complicated. And so we basically going to shut that down as well, like basically assuming that the government cannot engineer a specific Euler equation just for the purpose of like reducing the tax distortion in this economy. And this is somewhat similar to what this paper published in the Journal of Finance is doing as well from Greenwood and Sonnenstein. Yeah, so there are the two comments I have at this point on how specific this problem is, but I feel free to jump in if you have more questions.
Can I ask something?
Yeah, sure.
It's related to you have a fixed fraction of foreigners holding the bonds.
That's right. Yeah.
So like we're going back to the search and all that. I would imagine that when you buy these bonds and you change the maturity for the foreigners, it looks very different than from those domestics because foreigners cannot get interest on reserves, right? Like if a foreigner is holding the cash and you buy these bonds and throw cash onto them, they have to try to go overnight repo or doing all these kind of things to actually get the interest on the same interest that you're looking at. So this phi, like it's just kind of because it goes back here when you maximize the welfare, like this phi is actually moving around as the government kind of changing the maturity of the debt. I don't know if there are papers actually trying to look at that.
I see. Yeah, we didn't really do that. I guess in order for this channel to be effective, you need some form of like an intermediation friction. And in that case, this would be there. In a sense that now if you change the maturity, if you basically do QE, now you have, you're going to replace some bonds that can actually be held by foreigners by reserves that cannot be held by foreigners. And so for that reason, for foreigners to basically be absorbing this shift, you need some intermediary. You need basically like the US banks to act as an intermediary and maybe be active in the repo market or something like that in order to intermediate the position they have in reserves.
Yeah.
I think that could be happening. We haven't had a look at that. That's my answer, but it's an interesting thought. The fact that the proportion is time varying, we're also going to abstract from that. Effectively, what's going to happen is like for my main analysis, the foreigners are not going to matter actually. And the reason why they're not going to matter is because we are going to assume that everything is priced in. And so therefore their demand is going to be priced in as well. So it's not going to affect what you do from an ex ante perspective and how you want to change the maturity of the government debt. This is still going to matter from an ex post perspective, because if you only care about the domestic bondholders and the foreigners, then it means that whenever your interest rate goes up, there's more of a leakage going to foreigners. So for like domestic bondholders or even like just domestic agents, then now there's an ex post cost. But I'm going to get back at that when I go to the quantitative estimates. Okay,
Quentin?
so
I have a few comments / remarks. Can we go back to the objective function?
which one? This one?
Of the government's objective function.
Oh yeah, so this was one I was. Yeah, this one. Yeah.
Yes. So first, one question regards time consistency. So typically a problem set up like this would be time inconsistent.
Yeah,
but the fact
it is
that
time
the
consistent.
government, it is time inconsistent.
It is time consistent, and we are not assuming any commitment here.
Okay.
So all the solutions I'm going to give you are going to be, yeah.
I actually suspected it was time consistent. The reason is that the source of time inconsistency with long-term debt is that you're manipulating prices. If you take prices as given, I wouldn't see a reason why it's time inconsistent. So I wanted you to clarify that. When you have long-term debt and the government actually manipulates prices, you go back to cost conjecture. Like the government acts like a monopolist of a durable good.
No, it's exactly right. So
but here you're taking prices as given.
Yeah, exactly right. The time consistency is not going to come from there. I should have been more precise as well here, in the sense that although the government does not takes prices as given, it's still going to internalize what is the effect of prices on output. So output is going to depend on how how much risk, or the risk level, the redistribution of risks that is going on with like the debt schedule, and so that's the part that's going to actually internalize, which is in a general equilibrium model, and it's going to be exactly the same as changing prices as well. The only thing we are saying here is that the government does not try to manipulate prices for specifically the purpose of reducing the tax distortion coming from here. But otherwise, they're still going to get through output, and so that's still going to generate some time inconsistency problem here.
I see.
Yeah, the time consistency.
It would love to say, it would love to tell the bondholder, I'm not gonna raise taxes in the future,
exactly,
so that you're wealthier.
Exactly.
And
get more traction.
Consume more today.
And consume more today, exactly.
Okay.
That's what's going on.
Yeah. Okay, and the other question I have is, at some point, in my paper on maturity with Galo Nuño and Pasadore, we looked into what is the mandate of treasuries, of the Treasury Management Office.
Yep.
And the mandate there smells a lot like the objective function you have here, in that the mandate is minimize the cost of rolling over debt.
Yeah.
It's like play with the yield. I mean, there's no mandate like manipulate the yield curve. There's no mandate about smooth taxes. There's no mandate about demand stimuli. It feels a lot that this objective function has a little bit of a flavor of that. In particular, I suspect that if you drop the y and you make the tax cost linear as opposed to square, it's that objective function.
Oh no, then we don't have an interior solution anymore. So because here effectively, so it's exactly what you're saying, in the sense like I'm actually going to define rollover risk as moving away from the full tax smoothing solution. So here is going to be about tax smoothing. But I also agree that I think it exactly matches what these treasury offices are trying to do, in the sense that they don't want to be taking too much exposure to an increase in interest rates and now having to refinance the debt at a higher interest rate. I think fundamentally that's what they are doing, and then there's basically a trade-off showing up here. But I think effectively it's exactly the same as rollover risk, in a sense of like wanting to smooth taxes, which is exactly what I'm going to get at now, actually.
Okay, right. And you said it wouldn't be interior. It's because the discount factor of the government coincides with the bondholder.
I think what I'm trying to say is that the only reason why we have an interior solution in this model for the optimal maturity of the government debt, I think it's just not going to be defined, actually. I think that's what I'm trying to say. I might maybe Adrian or Antoine might jump in if they have a more precise answer here. But in order to get an optimal solution for the maturity of government debt, you need to have some convexity here. Maybe it's going to be clearer if you give me like 2 minutes, or I'll go through the slide for the solution. Okay, so unless you want to say something else here, or maybe Cyril?
Yeah, sorry, I have a
no,
question or a comment. So here it seems that you have a real model, but if you had a monetary model, then it would be easy, and you were to distinguish the government from the central bank, then the rollover risk would disappear in the sense that the central bank would just replace the market and buy the short-term debt of the government. Now, of course, this would increase the money stock, right, which would create maybe inflation in the monetary model. But this would hurt the bondholders, right? Not the hand-to-mouth agents.
Yeah, so the redistribution effect would be different in that case. Here, what we're trying to do is like try to stand away from the distribution effect. Although also because we don't have, I think if you want to get at, then you need to be much more careful about the way you model the economy and with all the GE effect. And you're also right that if I was to remove my monetary dominance assumption here, which I guess is what you were saying when you said a monetary model. So all these losses can be also absorbed by an increase in inflation instead of being an increase in taxes. We're going to assume, for the purpose of the paper, we're going to assume that this is actually going to happen through taxes, through distortionary taxes. I think there will be some generalization of what we are trying to do here if inflation would be exactly as distortionary as taxes. But maybe I don't want to be going too much into that direction, because I think there are much more political economy stuff going on as well, maybe some non-linearities and things like that. Okay, so what is optimal conventional monetary policy doing in this case? Well, effectively, as I mentioned before, when you are outside of ZLB, what you want to be doing is setting the interest rate exactly to the natural rate, which happens to be this formula over here, so that output is exactly at potential. And then when you get at the zero lower bound, effectively what you want to be doing is like putting the interest rate exactly equal to 0. And in that case, you're going to get output below potential, which is what we see here. And this is going to open the door for actually wanting to do something like QE, meaning like shortening the maturity of government debt. Okay, but first let's look at what's going on whenever you're not at the zero lower bound, or zero bound is not binding. And so here in this very simple model, the solution is going to be very straightforward. What the government wants to do is effectively smooth taxes, both across state of the world and across time. And so effectively it's going to set up a tax schedule that's exactly going to spread out, according to the discount factors, it's going to spread out the G0, which is the public spending, or the public debt that needs to be financed. And how do you do that? What's the implication for the maturity of public debts? Effectively, you're going to implement this tax schedule by issuing bonds in a way that's going to make it such that you're never going to take any rollover risk. So you're also going to exactly spread out the debt issuance between short-term debt and long-term debt. And if you do that, then you're going to end up in a situation is for whatever is the state of the world, whatever is the level of interest rate in equilibrium through the Euler equation, you never have to roll over debt. And so that the B1S always going to be equal to 0. And so that's the notion in which there's no rollover risk. And we're going to see that how getting zero rollover bond is going to make it such that you want to deviate from this fully hedged or full tax smoothing solution. Okay, but in order to get there, now we want to talk about QE. So QE is not about the quantity of short-term debt that you issue or the long-term debt you issue, rather it's about the proportion. So we need to reformulate the problem slightly. And so what we do here, we just define D as being the total value of the bond outstanding. And then we define S as being the share of the short-term debt. And because that's what we want to look at. We want to see how being at zero bond is going to affect how much of the share of the short-term debt you want to issue. And then I also need to define this additional term, which is going to be the one period return on the carry trade strategy, just effectively because in this model we are going to have some term premium. So we need to take that into account when writing these problems. Okay, so the government problem 0 can be reformulated in the following way. There's not much intuition of looking at the formulation per se, but as you're going to see, the first order conditions are going to be quite intuitive. Just defining a bunch of additional terms, I'm going to use S star to denote the full tax smoothing short-term allocation. So how much we invest in the short-term bond relative to the total debt outstanding in order to fully smooth taxes and being completely hedged. And then I'm also going to use the notation M to denote the discounted variance of this carry trade return that takes into account this carry trade and the fact that we have the term premium. If we were to have risk-neutral agents, this term would basically just reduce to the variance of interest rates in this economy, which is exactly what they have in this Greenwood and Sonnenstein paper. Okay, so let's just do a first sanity check. We're going to see what's the zero lower bound. When the zero lower bound is not binding, what is the first order condition of like maximizing this problem with respect to S? And what we find is that we basically get the following first order condition, which tells you that you should put S equal to S star, meaning that you're going to implement the full tax smoothing solution, exactly as what we had before. Okay, but now we want to look at what we're interested in, which is what happens when you get at the zero lower bound. And in this case, we are going to get the same left-hand side, which is going to be the marginal rollover risk that you take by deviating, moving away from this optimal tax smoothing solution. And in this case, because you are the zero lower bound, there is going to be a trade-off. You might want to deviate from this optimal tax smoothing solution if this derivative here is actually positive, meaning that the output that you have is actually increasing in the share of the short-term debt. And I'm going to explain why this might be the case in this model now. Basically, when you increase in this model, when you increase the amount of short-term debt, you're going to make taxes being more procyclical for the hand-to-mouth holders, and therefore bondholders' consumption is going to be less procyclical. So there's a redistribution of risk that is coming from the bondholders to the hand-to-mouth that are the taxpayers in this economy. So effectively, you're going to redistribute interest rate risk from a Ricardian agent to a non-Ricardian agent. And therefore, what's going to happen here is that if you have a high enough risk aversion, then the bondholder consumption demand is going to increase because their precautionary savings is basically declining. And so for that reason, we might be in a situation where we have this derivative term being positive. And in that case, the government is going to want to deviate and shorten the maturity of government debt and being fine with like taking some more rollover risk on the margin. Now from there, we can just derive what is the optimal size of a QE program. The optimal size of a QE program is just going to be given by the right-hand side here. There's going to be mean that I explained. But otherwise, the solution is actually very intuitive. It just tells you that the optimal size is increasing in the strength of the output effect. So the more traction you get on output by shortening the maturity of government debt, this derivative here, the more you want to be doing QE. It's going to be decreasing in the level of tax distortion. This is my alpha here, meaning the more distortionary taxes are, the less QE you want to be doing. And it's going to be decreasing in the dispersion of interest rate risk. The more risk you have when you do QE, the more it's going to translate into tax volatility, and therefore the less you want to be doing. And then the reason why you have this mean here is basically going to be bounded by this Q upper bar, which is the size that it takes, the size of a QE program that it takes in order to get out of the zero lower bound. And the reason here is very simple, is that in this model, you never want to be doing any QE when you're outside of the zero lower bound. Why? Because QE has a marginal cost, whereas conventional monetary policy doesn't. So you always want to use conventional monetary policy whenever you can. Okay, so I think I'm running a little bit out of time, so I'm going to, unless if somebody has spent time reading that and wants to comment on these two results, otherwise I'm going to move on and talk about the quantitative parts. Yeah, so these are the two results I just mentioned before, that we have that pro-cyclical seigneurage are actually neutral. And then if you finance QE by issuing zero interest reserves, is also neutral in this case. Okay, let's go to the quantitative exercise, which is like really the core of the paper. So what we want to get at is how does a change in the aggregate government balance sheets and maturity of debt is going to translate into an increase in tax volatility and therefore an increase in expected deadweight losses. So we're going to try to do that empirically. How to get there? We are going to basically compute the distribution of the portfolio return for each of the QE programs. And we're going to do that by taking the actual size and composition of the portfolio for each programs. And then we are going to use some forecasting, some term structure forecast models in order to get a dispersion of the returns from an ex-ante perspective. And then once you have that, we are going to use that to quantify the implied trade-off for each of the QE program, meaning that we're going to estimate the model implied welfare cost that is expected at the time of the implementation. So from an ex-ante perspective, and then compare that to the output effect that's been estimated in the literature. And then we also have this additional exercise where we compare the realized economic losses that's coming from this output effect. Okay, so I think we're all familiar with what the QE programs have been. Here, maybe the thing I want to mention is that we're going to consider 4 or 5 different rounds of QEs. And one of them, we are going to call that the MEP for Maturity Extension Program, because this specific program actually did not change the aggregate size of the balance sheet, but was just like literally swapping the maturity, whereas others was also like an increase in the size. Here, they were basically selling bills and buying T-bonds. Okay, so how do we construct this QE portfolio? Well, the nice thing is that all of the securities purchased by the Fed are actually public. So you can directly look at the SOMA portfolio for the treasuries at least, and get at all of their holdings at any point in time. And then what we're going to do is basically translate that into 0 coupon equivalence portfolio in order to be able to compare apples to apples. And then for MBS, for the MBS part of the portfolio, we are going to have to make some assumptions there because we don't know exactly what they've been purchasing. So what we are going to do is to assume that they have the same duration as the average duration of the treasury part of the portfolio, which we think is a conservative assumption for estimating rollover risk. Why? Because the outstanding duration of the MBS is actually lower. It's around 5.1 year, whereas the average maturity of treasury is around 8.25 years. And basically, I can tell you that already that anywhere we are going to have to make some assumption here, we are going to always try to make it in the sense of being conservative. Try to increase as much as possible the size of this rollover risk, which is going to go against our results, basically. So on the liability side, we are effectively going to assume that the central bank is paying interest on reserves, which we are going to approximate with the interest they get on the 1-year bond, so that we can do everything in the same arbitrage-free term structure model. Here, the term structure model is going to be really off the shelf. We're going to take that from the Duffy and Kine 1996 paper in discrete time. We're going to assume a structure of 3 latent factors. We have like some data from yields from June 1971. And then we are going to do that like different maturity at the 1 month, 1 year, 5 year, 15 years for the model estimation. And then for numerical stability, we're going to use this paper from Hamilton and Wu. And we're just going to generate 1,000 paths of future factors in order to compute the whole term structure. And it's going to give us something like that. So here I'm basically sampling at the 1-year yield and at the 10-year yield, and this is for the QE1 program. So effectively, we're going to look at the end of the QE program, when all the purchase, at the end of the purchase phase of QE, what is the expected distribution of interest rates at the different parts of the yield curve. So here we have for the 1 year, and then we see we have the P50 here, and then we also have the realized with this dotted line here. And we do the same for the 10-year yield, and it gives us something like this. Now I'm putting the same thing for QE4. And then for QE4, what we can actually see is that the rise in interest rates that followed the end of the QE program was actually very large. Actually, at some point, it fell out of the P1, P99 bond. So it was highly unexpected. So that's something to take into account whenever I'm going to give you like the quantitative estimates. Although because the duration, average maturity of the portfolio of the Fed is going to be much higher than 1 year, the impact on the 10-year yield is going to be more impactful, and then we see that one is like less crazy than this one, basically. And we're trying to use option data to validate this exercise, which we haven't completely finished, but that's what we're doing now. So we need to make a couple of assumptions on how the QE portfolio is going to be working. And so what we are going to assume here is that the Fed is going to roll over the portfolio, keeping the maturity constant for all the time until it eventually unwinds the whole portfolio. And what we are going to assume is that the Fed is going to unwind the portfolio all at once at time big T. And if that's the case, then what we want to be looking at is the return on the portfolio at this specific maturity. And that's basically going to be just the return on a long-short portfolio, where the Fed is going long these long-term bonds and short the 1-year maturity, which is proxying the interest on reserves, effectively. And here we also need to take a stance on how long is going to be the QE programs. And so for baselines, we're just going to use 10 years as like a benchmark. It's a little bit unclear exactly how long the programs are going to last, because it seems to be there's always a new reason to do an additional QE programs coming up next. And so everything I'm going to show you is going to be conditional on this maturity here. We have some robustness when we increase or reduce that number. And if you increase that number by sufficient amount, then it's going to overrule the conclusion of the paper. We can discuss that.
So this is emphatically like not what the Fed did, right? So
yeah, I guess so. It's okay. I'm going to get back to this slide here. It's not entirely true that they don't ever sell the QE part. It seems like they want to go down, so they are going down here. They are going down here as well, and then that keeps happening right now. So here
it's predominantly hold to maturity, no?
Yeah. It's all roll-offs. It's when things mature, they don't replace them.
Yeah, sure. But I think for a purpose, that's fine. That would be the same. Oh yeah. The only thing that I really need to mention is that this is again meant as being conservative assumption. Why is that? Because we're going to get even more conservative than this. Actually, we're going to assume that exactly at the time where the Fed is going to realize all the return by selling the whole portfolio, the Treasury is also going to raise taxes to exactly compensate these losses from the central bank. And this is a conservative assumption in our world because this is the worst thing that you can do, because you have these convex distortionary taxes. What you want to be doing is smooth taxes across time. So here we are making like basically a worst case scenario in the sense of you do everything all at once. And so that's what we are trying to do.
Yeah, I was gonna go into that. Like in practice, you set taxes and you replace them every X amount of years when the Congress agrees into the tax reform.
Yeah.
So the other thing you could do is just throw it as as part of the tail of whatever you haven't refinanced.
Yeah, for sure. And that's going to make things much easier to absorb. But again, like I think we're trying to be conservative here, and there's also a notion that it's not all, sometimes fiscal consolidation reforms, they happen quite fast. So we don't want to be basically baking in some form of like tax smoothing here, because I don't know, you might take Argentina nowadays, or maybe I don't know, like Greece is another example. Many countries have been facing very harsh fiscal consolidation at once, and so for that reason, we basically want to compute like the worst case scenario. The worst case scenario is that you need to the central bank has to unwind all the portfolio all at once, and then the government is going to raise taxes all at once as well. If you want to relax these assumptions, it's going to make our conclusion stronger in a sense. I'm going to get back to that.
Okay, so how the conclusion will depend on, the conclusion will depend on whether it made profits or losses on its portfolio. So if it makes profits on its portfolio, it's actually boosting the welfare gains of.
Oh yeah, for sure. But that's the reason why we do everything from an ex ante perspective. So the main exercise, we also have that exercise in mind, the one you just mentioned. But here, remember, everything is really this Jensen's inequality term, which is actually an ex ante cost.
Okay.
And so that doesn't depend on the past, it depends on dispersion. So that's the reason why we are looking at the dispersion of interest rates. And we're basically going to move from the dispersion of interest rate into a dispersion of
and
returns.
Because of Jensen's inequality makes it worse.
Yeah, exactly.
Okay.
That's right, exactly. Yeah, so that's basically the dispersion now in returns, because you're using this equation to convert dispersion of interest rate to dispersion in returns. And then ultimately the question we want to ask is where the QE program's positive net present value, meaning that the QE contribution of this deadweight loss, expected deadweight loss, was it lower than the QE contribution to output? That's the empirical question we are going to ask. Here, I need to caveat that this is a bit different than in the theoretical part of the paper, where we would be basically looking at the marginals of these things. Here, we can only really look at the average. So it's kind of like a lower bound. But the issue is that we cannot really get at the convexity of the output effect. For that reason, we cannot really get an answer to whether or not what the central bank has been doing is optimal. We're just going to see if like what the central bank has been doing has had like a positive net present value. That's what we're going to get at. So the model was very stylized. So it was just like this two-period model. So we need to generalize it slightly. So the way we do this, just consider this infinite periods deadweight loss representation. And in that case, this I never know how to this Greek letter, I guess it's psi or zeta or something like that. Let's call it zeta function is capturing still this convex cost, distortionary cost of taxation. And so here, what we're going to do, we're going to follow what we do in the rest of the paper as well. We're just going to assume that this is quadratic and taking this specific functional form. And then we are going to use the literature in order to calibrate this cost. And the goal is to get at this basically delta Q L0, which stands for the QE contribution of this deadweight loss. So how do we get there? We are going to define this delta Q of L0 as being the difference between the deadweight losses of taxation that in the part that's coming from the QE programs, like the additional taxes or tax volatility that's going to come from the QE program, minus the part that doesn't come from QE. So it's the counterfactual without QE. And we are going to decompose taxes between the QE part and the counterfactual without QE. And here we are going to make the conservative assumption that I already mentioned, that you're going to raise taxes at period big T exactly to compensate, to recapitalize the central bank of the losses they make exactly at the time where they unwind their portfolio at time big T. So with a little bit of algebra, we basically end up with like two measures for this cost.
You're gonna have the aggregate demand, or it's purely consumption.
Yeah, so here I'm really focusing on the cost, and that's really what we think the paper's contribution is going to be getting at, like estimating this cost. Whereas and then eventually we're going to compare that to the output effect. And for that, we're going to rely on estimates in the literature. And so basically, because if I go back very quickly to my equation here, effectively what we are interested in is the left-hand side of this equation here and not the right-hand side. That's what we are going to try to do. Okay, so we end up with two measurements for this cost. And none of them is perfect, but I can explain what they do, and there's some intuition into it. The first thing we do is just we normalize this into by dividing by GDP. And then the second thing we do here is we basically assume that agents are risk neutral, and then we take a Taylor expansion of this cost. And if you do this, then we end up with basically having two terms here, and the interpretation for these two terms that this first term is like almost the variance of the return of the QE portfolio. It's just the denominator is a bit different because you need to normalize, and it's the way we would normalize this thing. We can think basically about it as being a variance term. So this is going to depend on the variance of the portfolio, increasing in the variance of the return of the QE portfolio. And then there's a second term here that's going to depend on the covariance between the return on the QE portfolio and the tax rate that is they will already be there in this counterfactual world without QE. So effectively, the worst case scenario would be if you have a coefficient of correlation of -1, meaning that you're going to get a negative return exactly at times where already your tax rate would be high for other reasons that are not captured here. And so effectively, that's how we get to our upper bound costs. So in this case, we are going, again, try to make some conservative assumptions. So we are going to relax the assumption that agents are risk neutral, but we're going to assume that these covariants basically are the worst they can be. So and if we do that, then this is going to translate into this term being becoming really the variance of this term times the variance of that term here, as before. And then now we will basically need to add up the variance of this additional term in the worst case scenario where the covariance of the taxes and returns are basically equal to -1. And that's what we are going to estimate here. But what's very important here is we need to calibrate this alpha. So alpha is going to do all the heavy lifting because that's the calibration of this convex cost. And this is what's going to give us the size, is going to modulate the size of these distortions. So in order to do so, we basically going to match it to the public finance literature. And again, take kind of like one of the largest number we can find, which is from this paper by Says and Al, that gives us a number of 0.4. So basically 0.4 means that for every dollar of tax, there's 40 cents of distortion. And it gives us a distortion of an alpha of 1.52, which is consistent with the Greenwood et al. Calibration as well. Okay, so now we are going to estimate these two measures using the simulated path for the variables using the term structure model. And we end up with this table, which is like really the punchline of the paper. So this paper basically has a measure for the cost of QE, the QE programs in percentage of GDP. And these are the two measures that I just described. So the first measure is the risk neutral measure, and the second one is our upper bound cost. And so if we can maybe look at this last column. So here we accumulate over the 5 QE programs. And what we find is that the P measure cost is 0.25% of GDP. And this upper bound measure is 0.70% or 0.69% of GDP. And so what we want to be doing is basically comparing this upper bound cost to what is the benefit of QE, which has been estimated by the previous literature and is basically surveyed by this paper here. Which provides a meta-analysis of the output effect of QE. So we're basically going to average across different papers. And actually the punchline of this paper here is that they find that academics find a much lower effect of QE when compared to central bankers. So here we're basically going to report both. We find that when you include central bankers, then you get to this very high number of 3.36% of GDP across all the QE programs. If you only include papers written by academics, then you get to a lower number of 1.20. But basically in both cases, that number is higher than that number, which makes us conclude that QE programs were actually positive NPV value, which wasn't necessarily our prior when we were trying to get at this estimate in the first place.
Quentin, I have I'm very puzzled by the result, and the reason is the following. From the 2 slides back, when you go to the objective, it seemed as if you were setting up the problem, toward getting negative NPV from.
Yeah, that's exactly what we're trying to do. Yeah.
Yeah, but so this is where I'm puzzled. You're looking at an ex-ante welfare measure. Yep. And your objective function uses the risk neutral probabilities from the market. So it's de facto as you playing a game against the bondholders who were risk neutral.
I know this one. No, just for this one. This one doesn't assume risk neutral.
No, I know, but I know you don't have to assume risk neutral. It's de facto as if they were risk neutral because the risk neutral probabilities are in the objective of the planner. So you by having the ratio of lambdas times the expectation, that converts them into risk neutral probabilities. So de facto, it works as if you had a problem where you, the planner, are facing some quadratic cost against an agent outside of your economy that is de facto playing the role of a risk neutral agent. And everything would tell me that in that setup, you would want to offload all the risk onto the bondholders. And here you're looking at QE, which lengthened the maturity of your assets, which are, because they're long-term, are bearing more risk. So the, risk exposure went up for the planner in a setup that smells a lot like, lenders are risk neutral and you have a quadratic cost.
But I don't see the risk neutral thing still.
Then you're using their discount factor.
For this exercise here, we don't use their discount factor. That was just like for deriving the analytical results. Here we're just in this one here, we are making this assumption that indeed we're assuming they are risk neutral. For this one, we are just remaining.
That changes it. That changes things. That makes it a race between their risk exposure and yours. So it's a game about insurance.
So for the sake of time, I should probably conclude. So I'll just mention very briefly that if you want to have a look, we also have in the paper some exercise where we look at the ex post. Maybe if you have some question, I'm happy to answer that as well. Or looking at the ex post costs. So not doing the ex ante exercise, but looking at ex post for like different parts of the distribution, different percentile, and also the realized cost. But I'm going to conclude by saying that basically the purpose of this paper is to propose a framework to study the cost benefit of QE, especially measuring the cost, the fiscal cost of QE. What you find with this optimality condition tells you that the marginal increase in rollover risk should be equal to the marginal increase in output. I guess gives you the optimal size of a QE program. The model implies also that mark-to-market losses are actually real economic losses whenever taxes are distortionary because of this Jensen's inequality term. And also it's inherent to the duration extraction mechanism of QE. You don't have any free lunch here. If you want to do QE, you need to be able to take risk. Otherwise, it's not going to work. Quantitatively, we find that risks appear reasonable given the large output effects. You buy the large output effect has been found in literature. And by this result, I'm going to condition that result on series of assumptions we've been making. The first one is that the central bank ends up actually unwinding the portfolio. Otherwise, it might be different. Second one is that we are relying some estimation for the interest rate process. The third one is that we also rely on the QE effect that's been found in literature. And the last one is that we're also abstracting for the political economy interactions that might also be there and increase the cost. And so that's what I have. Thanks a lot for questions and participation. Happy to take questions.
Perfect. Thanks a lot, Quentin. Yeah, we're great in terms of time. So now we have another 15 minutes plus or minus for more questions. Those who are panelists can just unmute themselves and ask questions. Those who are in the webinar, they can use the Q&A function, and then I'm happy to read out these questions as well. So I can see there's already a question from Dirk, so please go ahead.
Yeah, thanks very much. One thing I didn't fully understand was whether you assumed that for the quantitative exercise that you start before you engage into QE from a situation in which you already do the best you can in terms of tax smoothing. Yeah, so what I have in mind here are these exercises by Bohn or by Fari that they were sort of trying to see, how are the tax distortions actually correlated with the shadow value of how is the shadow value of public fund correlated with the asset structure that the government actually has exposure to? And is there some gains from trade that the government could still exploit? I think you could do this, right? Since you simulate the term structure, I guess you would also have to simulate somehow the distortions of government spending or something like this, and then see how these things correlate, and then to figure out whether you actually do start from a situation in which engaging in QE is a bad thing. Maybe it's a good thing, right? Maybe you improve risk sharing by doing that.
Yeah.
And there's a second and a third part that comes with that. I mean, if you really want to compare that part of costs with the benefits from whatever these output benefits are, wouldn't you expect that if you start to affecting output, you would also on that side then affect, some exposure of the government to tax revenue, to government spending or whatever that is, which you would also like to insure against with this new asset structure that you're playing out with on the QE side, right? Isn't that something that you would then have to take into account when you confront these two issues?
Yeah, so these are two great comments. And you're absolutely right that maybe I should have that as like more prevalent in the talk, and also maybe having that as an additional bullet point on this slide. Thanks. What we are assuming, we're taking as given, we're basically assuming that whatever the Treasury is doing before the QE program was actually optimal, in the sense that anything that happens there is like a deviation from this optimality from the central bank. I don't think we necessarily mean that as a literal assumption. I think it's more from the sense of putting yourself in the shoes of a central bank that has a specific mandate, and the mandate not necessarily being undoing the mistakes that the Treasury might be doing. I think that's kind of like more where we are coming from. And again, because that's going to interact with like some political economy interactions. But we definitely should make that assumption much more prevalent, because that's very important. And you're exactly right. And maybe it's worth actually doing this exercise that you suggested, nonetheless, of looking at the covariance with these additional things that can happen. And then the second point, I don't know if Antoine wants to comment on that, because I know you've been thinking about it quite a bit, but.
Yeah, do you mind stating again the question? So I was focusing on the first one.
If you really want to compare those, the costs that you look at with the benefits that the literature has identified, I'm wondering whether those benefits wouldn't also come with some additional implications for the risks the government is exposed to, and whether you're changing the exposure of the government would then also have to take into account that you change the G or tax revenue or whatever that comes with the business cycle implications that you have.
No, that's right. I mean, it also relates to your first question, which is precisely by assuming that the only way that the government affects or generates distortions, let's say, is through the change in the duration rather than the change in the distribution of taxes. And the reason for that is that we don't want to model. We don't think we can quantitatively distribute the positive effects of QE through different channels that are going to be relevant for what you have in mind. And so instead, you should think of the government may create distortions to other ways, and what we claim we're able to measure correctly is the increase in tax distortion that only comes from this direction extraction mechanism directly rather than indirectly through the effect it has on the real economy.
Yeah, another way to put that is like anything is going to affect the covariance between government debt value and taxes. And some is going to be missing from here. Like all this effect of QE, as long as it affects some covariance there, that's going to be missing. There might be some additional benefits or additional costs we are not going to take into account, and that's
but why don't you want to do that? I mean, the first part of the exercise I think is very convincing in building intuition, but that intuition is sort of in the Fari paper, for example, right? We sort of have that notion. So what you could do, I guess, is that as you simulate the term structure, you could simulate some implications of QE on output or on tax revenue or whatever that measure would be that is the relevant one. And then ask the question, in this new world that we live in with QE, are these orthogonality conditions that optimal exposure of the government would require, are they still satisfied, or are we moving in the right direction? So you could do this on the basis of what you're actually doing halfway in some sense, I feel, right? Would be a super interesting exercise, I think.
Probably a good suggestion. We did do it until now, I guess, because these are second order terms. But I guess we can still, we probably need to also think about which ones are the ones that matters and all this. But like, yeah, it's a great point. Yeah, we should probably do that. Thanks.
No one else has a question. I have one. So two related things. So we write rollover res. There's the whole sovereign default literature that means something different than what you mean here.
Yes, exactly.
But that literature, and then more specific about that literature, has a specific reason of for maturity, right? That there are some papers that look at you should, like, governments that face more sunspot crisis, like rollover crisis.
Yeah.
Rollover related to that literature, not what you mean here.
No, exactly.
They have incentives to extend their maturity, which kind of like that, right? And that actually kind of lower yields. And for here, you look at the US, it doesn't matter, but like when you think about the European Union and all the countries that like this central banks doing QE, there is this real question of how actually this how this channel would play out with the additional risk that you're introducing by kind of like some like self-fulfilling crisis and all those additional types. So I would be careful of comparing the US when you're thinking about Europe, and there are all the caveats there.
You're exactly right. And I think the reason why, I think we're pretty comfortable making that specific assumption for the US, although you never know, I guess. But
yes.
And so, but in a way, the two are kind of very related as well. So the convex distortionary taxes could be interpreted as being also some political costs on raising taxes. And then I mean, it would probably be quite straightforward to move from what we have here into like a Calvo type of model where there's like multiple equilibria. And in that case, you're going to also affect the probability of getting into this rollover equilibrium or this run equilibrium or something like that. We felt like for the it's going to be also much more difficult to quantify. That's the other reason why we didn't do it. I think this one's like very straightforward to quantify in a way, caveating all discussion we had with Dirk now. But I think in a way the run, like the probability of moving to run equilibrium, I think is difficult. It's probably much more like there's like some regime shifts and things like that. But I agree, it's like that's the main question now for what's going on in Europe, for instance.
So, oh yeah, Todd, go ahead, please.
Yeah. So I had a question. It's kind of related to Dirk's first comment, but viewed a different way. Have you guys thought about, could you use this framework to think about what would be a good division of assignments between the Treasury and the central bank? Like if you start with, you have an optimal policy, and now you have these two separate decision makers, is having the Treasury, try to minimize the cost of financing the debt a good assignment, or what are your thoughts?
Yeah, it's also a great point. So I think effectively what's going on here in the model, there's nothing normative about it, and I don't think it's good framework for something normative. But so there's an implicit conflict that appears whenever you get at the zero lower bonds, because the central bank wants to lower maturity, and then the Treasury probably still wants to be being conservative with respect to rollover risk. Effectively, I think implicitly what this model is suggesting is that when you get a zero lower bonds, maybe it's good for the central bank to be in control of the maturity. If you take this model at face value, I'm not recommending. I think there are like other costs are captured here, but that's what the model would suggest. And I think outside of zero lower bond, this model would suggest that the Treasury should be in control of the maturity. If you think about the Treasury as having the mandate to manage the tax risk that the citizens are effectively taking. That's really my 2 cents after I've been working on this.
Yeah, I see. It makes sense. It's sort of, as long as the central bank has a monetary policy tool that works, it doesn't need to be involved in this. But if it doesn't,
yeah, that's what comes in from here. I don't know what are your thoughts on that, but
yeah, I don't know. I mean, that makes sense in terms of the model. Because I think there's an interesting open question of how do you want to think about the central bank's mandate in these situations.
Yeah, exactly. And the whole question is also about what's going to be the implication in terms of like shifting from one regime to another.
Yeah, exactly.
Not what we are missing here. That's why I don't want to go too far.
Exactly. Yeah. Okay. Yeah, that makes sense. Thanks.
So I guess your quantitative results taken together with your optimality condition that you have on this slide, together they suggest that the QE implemented was too small. And then I was wondering whether you have any sense of what, according to your research, the optimal size of QE would have been. I guess it's tricky because you kind of have to scale the output effects, which you don't. But I was wondering whether you have
so the main trick is so I didn't mean to cut you. I think the main trick is that we really have, we can only say something about the NPV and not really the marginal. So it's entirely possible that even though these QE programs were positive NPV, it's possible they were like still too large because they were going beyond like what would be like the marginal benefits. But they're overall positive. I think that's the only thing we can really say here. The other thing as well is that there's the going back on my slide as well. There's the mean thing as well. So remember here, you don't want to be doing QE besides above the size that's going to get you out of zero lower bond. And so even though maybe the cost benefit was actually positive, it could be, from what we measure, it could be that the mean was actually kicking in. And in that case, we might be a bit careful as well and like drawing conclusion in the other direction, basically like saying the QE were not large enough. I don't think we want to be saying that.
I see. Yeah.
Yeah.
And then some more technical question in the theoretical part. You mentioned that you need to assume that the hand-to-mouth consumers share a larger tax burden than the bondholders.
Right.
So I was just wondering whether, like, how do you map these agents to reality, and is this like a justifiable assumption, or is this?
Yeah,
Because at first glance it sounds like it's tricky to justify, but I was wondering whether.
I think so. So that one I'm relatively comfortable with in the sense that I think with the bond market as being kind of like a very concentrated market, which is also you almost need that for having a positive term premium in equilibrium in all these models. So I think there's like this notion that the bondholders are like kind of like somewhat specialized, very concentrated agent that therefore gets like a positive risk exposure to interest rate risk, whereas the most of the taxes are coming from the non-bondholders, which are not that large. So I think that's where I would map it to reality. It's like the proportion of tax, because these are just very small. The proportion of people that are actually holding bonds, especially the ones that are actively trading and providing elasticity in this market, is actually relatively small. And therefore the proportion of tax liabilities they have is going to be much smaller than the rest of the agents in the economy.
Okay.
I mean, one other wedge that you could introduce here, maybe rather than having the hand-to-mouth versus the bondholders, is that you have some liquidity benefits, and some group has more exposure to those liquidity benefits, and therefore you get some effects of that kind, right?
Yeah, that's exactly right. I think it's exactly right. You can get some traction that way as well, and then you're also going to change prices if you redistribute things. Yeah.
Like, so now that you explained this kind of brings something to me. Like, so these guys that are hand-to-mouth, so they are like most of the taxpayers, right? Like you would imagine that's not like these people are not holding anything. They are holding capital, they are having business, whatever. And then you're now introduce this additional tax risk on them, and they should have reasons to increase precautionary savings, right? So you're trading off the precautionary savings of the bondholders with the precautionary savings of capitalists, right?
Yeah.
Isn't that like a concern?
Okay, so two things. First of all, I think again, I think we really think about the model as being kind of like illustrative. I think there are like many different channels. I think once you get to have some traction on the term premium and on the long-term rates, then you would like start triggering some additional channels that would kick in general equilibrium, like an investment channel, like a general equilibrium wage increase, and which then would also foster some aggregate consumption. So we're not really married to this specific way of modeling this output. And again, we really think about the contribution of the paper coming more from like estimating the cost side. But I would still believe that as long as you basically buy the assumption I was discussing with Lucas, that you get like a disproportionate holdings of bonds with respect to your tax liabilities, there's the interest rate risk redistribution channel, I think, is going to kick in to some level, and that's fundamentally what you need in order to move to lower the long-term rates. And I think that's really what we are after. And this will be exactly what's captured again, like in a preferred habitat via Vajanov's kind of setting, where you think there are like some arbitrageurs in the market that are overly exposed to the bond market for some reason. Maybe some mispricing, maybe some liquidity demands, like Dirk mentioned. And then once you have that, I think then you have traction on the long-term rates. And then when you have traction on the long-term rates, you're going to get some effect on output. Here in our model is very specific, but I think they can generalize. I don't know if I answered your question, or your comment, I guess. Okay, good.
All right. I guess it's a good moment now to kind of unwind the formal part, at least, to end the recording. So I want to thank Quentin again for a great talk, and also I want to thank the panelists for an excellent discussion. I want to highlight that our next seminar is going to be on the 9th of June. It's going to be Guido Menzio presenting Markup's search theoretic perspective. So please join us again for that. I guess we can now end the recording. The panelists can still stick around if they want for more informal chats, but this is the end of the more formal part. Thanks, everyone.
Yeah, thanks, Lucas. And thanks, everyone. I appreciate it.